Expert insights: low Ethereum gas fees are beneficial, but not for everyone. Seed Fadilpašić verified by Elena Bozhkova. Last updated June 5, 2024, 3:59 EDT. 21-minute read. Key takeaways: the Ethereum fee decrease was caused by the Dencun upgrade, the surge in Layer 2 solutions, and the latest shift in the crypto market. Most experts agree that low Ethereum fees can last, but changes in regulations and market conditions will define their future. Lower gas fees enhance accessibility for users and developers, potentially increasing Ethereum's network activity and demand for Ether. Concerns exist about the impact of low fees on Ethereum's deflationary mechanism and the potential consolidation of power by larger entities, which could affect the network's decentralized nature. Lower fees may increase security risks like spam and poisoning attacks, but Ethereum's continuous enhancements and active community are expected to protect the network. The gas fees on Ethereum, the world's second largest blockchain by market cap, fell significantly following its recent massive upgrade. CryptoNews spoke with experts about the key factors contributing to the fee decrease, how sustainable the trend is, and its impact on users, the ETH price, DeFi, and NFTs. The overall verdict is that the changes are mostly positive, but there are some potential downsides and security issues to keep an eye out for. Here are the industry experts who contributed to this research. Peter Eberl, President and CIO of Castle Funds, an investment firm managing funds invested in Bitcoin and other digital currencies since 2017. Stepan Nilov, consultant at Blocksbridge, a research and communications firm for the cryptocurrency industry. Ryan Lee, chief analyst at Bitkit Research, an arm of crypto exchange Bitkit. Gary Kabinkin, leading market analyst at blockchain analytics platform Santiment. Edward Wilson, social media lead and member of blockchain analytics platform Nanson's trend spotting division. Stan Pauman, founder and CEO of Web3 payments platform Helio. Patrick Gruen, founder of Perpetuals.com, a MiFID Roman II market infrastructure startup for crypto derivatives trading. Vijay Marolia, the managing partner and chief investment officer of multi-strategy investment firm Regal Point Capital. Gabriela Kuss, the COO of TCS Blockchain, who served as a board director at the Global Digital Asset and Cryptocurrency Association. Alex Dulub, founder of security browser extension Web3 Antivirus. Read their insightful opinions below. Why Ethereum gas fees dropped. Following the Dencun upgrade, charts showed the Ethereum gas fee drastically dropping, as was expected. CryptoQuant found that the upgrade caused the median transaction fee and the total fees burned to plummet despite high network activity. The average transaction fees peaked at nearly $200 in May 2022 per BitInfo charts. It would occasionally fall below $2 throughout April and May compared to the whopping $30 in March. According to the charts, the average transaction fee has hovered between $2 and $7.08 over the past week, levels also seen before the upgrade. Ethereum average transaction fee USD, raw values. The median transaction fee fell below $1 in mid-May after climbing to $13.05 in mid-March and now fluctuates between $2 and $3, similar to levels observed before the upgrade. Ethereum median transaction fee USD, raw values. The experts speaking to CryptoNews have noted several key factors contributing to this decrease, including the recent Ethereum upgrade, the surge in the number and popularity of Layer 2 solutions, and the latest shift in the crypto market. Gary Kabinkin, leading market analyst at Santiment, told CryptoNews, historically, Ethereum gas prices are influenced by network congestion, which is directly tied to the number of transactions being processed on the blockchain. The drop you're observing could be attributed to several factors, including improvements in network efficiency or a temporary decrease in transaction volume. Dencun upgrade. Perpetuals.com founder Patrick Gruen argued that the fees are a result of a combination of factors, especially the Dencun upgrade or Cancun EIP 4844, and the fact that activity has moved from the Ethereum blockchain Layer 1 to Layer 2 solutions or other blockchains like Solana. Gabriela Kuss, the COO of TCS, also mentioned the recent Dencun upgrade, as it was said in part to help support further scalability of the second largest blockchain. ETH gas prices peaked in early March 2024, right before the Dencun upgrade was implemented, explained Peter Eberl, president and CIO of Castle Funds. This upgrade reduced the amount of data storage needed by Ethereum, which in turn lowered gas costs. Stan Pauman, founder and CEO of the Web3 payments platform Helio, commented that by separating data from the mainnet and Layer 2, Dencun has significantly reduced congestion and paved the way for a more scalable and accessible Ethereum. Layer 2 surge. Another correlated factor, which has been notably amplified by Dencun, is the Layer 2 chains. According to Stepan Nilov, a consultant at the research and communications firm Blocksbridge, the growing dominance of L2 blockchains like Base, Blast, Arbitrum, and others is the main factor contributing to the drop in Ethereum gas fees. We see a lot of on-chain activity shifting there, Nilov said. This shift is amplified by Dencun, which introduced blob transactions, slashing gas fees on Ethereum L2s by up to 99%. Before that, a swap on an L2 chain could cost up to several dollars, he explained. While it was a much smaller fee than on Ethereum at the time, it was nonetheless not low enough to not take these fees into consideration for users. Patrick Grun explained that the gas price on the Ethereum base layer depends on the number of transactions. Therefore, moving to Layer 2 solutions reduces the activity and the gas fees. Grun, too, finds that Dencun has helped Layer 2 settle transactions on Ethereum much more efficiently. It decreased the fees associated with Layer 2 solutions and decongested the Layer 1 network from clunky batch settlements. Santimans Kabinkin, in a conversation with Cryptonews, added that the introduction of Layer 2 scaling solutions and the increasing adoption of alternative networks for activities like trading NFTs or DeFi operations could reduce the strain on the main Ethereum network, thereby lowering gas prices. Stein Palman also confirmed that the growing popularity of alternative blockchains like Solana is resulting in less congestion on-chain. Additionally, greater numbers of Web3 natives are utilizing Layer 2 solutions such as Optimism and Arbitrum, alleviating pressure from the Ethereum mainnet. Shifting market. Bigot Research Chief Analyst Ryan Lee says there has been a shift in user interest that has resulted in lower gas fees. Lee argued that the move towards ecosystems like Solana and Bitcoin, which offer alternative or entirely new experiences and functionalities, decrease the number of users within Ethereum. Edward Wilson, the social media lead and member of Nansen's trendspotting division, agrees, stating that Ethereum gas is dependent on network usage, and in the past few weeks, activity has been generally lower as the market has also taken a hit. Vijay Marolia, the managing partner and chief investment officer of multi-strategy investment firm Regal Point Capital, also noted lower demand, commensurate with lower prices for crypto as people are dealing with higher priorities. Read, inflation. Is this trend sustainable? Experts interviewed by Cryptonews largely believe the trend of decreasing Ethereum gas fees is viable, particularly as blob transactions gain wider adoption. Edward Wilson noted that it is natural for Ethereum gas fees to ebb and flow with market conditions. This is normal and sustainable. If we expect the market to heat up, then we'll see gas fees increase as more opportunities present themselves. Vijay Marolia, however, is skeptical about any significant reduction in transaction fees soon. He notes that despite decreasing inflation rates, the cost of living and mining are on the rise. Patrick Grun also finds it challenging to predict the duration of low fees, but he doesn't anticipate a return to the high fees of the past in the foreseeable future. Looking ahead, the Ethereum network anticipates further advancements such as proto-dang sharding, a preliminary phase of the full vision for sharding Ethereum, which promises increased scalability. This development, however, might take several years to materialize, meaning Ethereum's fee levels will largely depend on the adoption and efficacy of Layer 2 solutions, including future innovations like ZK proofs and data availability sampling. Peter Eberl emphasized the long-lasting impact of recent developments but cautioned that gas prices will still experience volatility based on network congestion. This is peak pricing, he stated, adding that there are other EIPs under consideration whose goals are to further reduce gas fees. This ongoing development cycle indicates that Ethereum is far from finished with its technological enhancements. Stable and lower gas prices could persist. Gabriela Kuss and Santimans Kabinkin both acknowledge that Ethereum gas prices are subject to fluctuations influenced by technological and broader economic factors. Kabinkin added that the inherently volatile and reactive nature of the crypto market means price movements are expected to fluctuate over time. He said, a sudden surge in demand for Ethereum-based transactions, possibly driven by a new popular application or a shift in trader sentiment, could quickly drive gas prices up again. Kabinkin also noted that the critical point is to monitor how technological advancements and shifts in market dynamics interact. If Ethereum's scalability improvements can match the growing demand, there may be a more stable lower bound on gas prices. Yet any significant increase in network activity could offset this, he cautioned. Despite this, the lower gas fees might promote more transactions, particularly with stablecoins on the Ethereum network, potentially boosting overall market activity without a corresponding increase in gas prices. Kabinkin concluded, while the current low gas prices may not be permanently sustainable given the volatile nature of the crypto market, ongoing technological improvements and strategic shifts in network usage could lead to more stable and generally lower gas prices over time. Quantitative to qualitative growth. Stan Paumann argued that the sustainability of low ETH gas fees depends on multiple factors, such as market conditions, user behavior, and further network upgrades. He believes the shift of Web3 users towards alternatives like Solana will likely continue to grow in both the short and long term, keeping fees low on the ETH mainnet. However, regulation has a big part to play, with favorable regulations potentially boosting on-chain activity, but stringent ones having the opposite effect, which could reduce fees further. Ryan Lee told Cryptonews that the processes we're witnessing could be seen as a competition between different blockchains for users. This indicates that cryptocurrencies are at a point where quantitative growth is transitioning into qualitative growth. This is indeed a sustainable trend that will be interesting to observe. Lee said it is a good opportunity for investors and traders to rebalance their portfolios. For users, it's a chance to take a fresh look at what blockchains offer today. Impact on users, devs, and Ether price. The impact of the low fees on the Ethereum price is difficult to predict. According to Patrick Gruen, external market forces and the second-degree effects of cheaper block space are the factors likely to be responsible for much of ETH's price action. Lower fees mean that users who were previously unable to afford to perform transactions due to high costs might now participate in the Ethereum ecosystem. This increased participation could lead to a higher demand for ETH. Castle Fund's President Eberl also highlights accessibility, commenting on how lower fees facilitate smaller transactions, boosting overall network demand and possibly the price of ETH. Eberl also discusses the impact on investors, particularly how current fee levels do not affect staking rewards but could lead to higher ETH prices, benefiting those with stakes in the cryptocurrency. Similarly, Regal Point Capital's Marolia and Stan Paumann both foresee a surge in Ethereum's price and adoption due to increased accessibility and lower operational costs. Stan Paumann noted, there is a natural correlation to the number of daily users on a specific blockchain and the price of the native token. The more users transacting on the ETH mainnet, the higher the price of ETH. Lower fees on Ethereum are good not just for users but also for developers. According to Ryan Lee in an interview with Cryptonews, reduced transaction costs could greatly increase the adoption of blockchain technology. This reduction could speed up the development of decentralized applications or dApps and lead to the return of users who use blockchain daily, for example, for payments and financial operations. Stepan Nilov also views these changes positively for the Ethereum network. He said, a big chunk of on-chain activity shifting to Ethereum L2s is strong evidence supporting the settlement blockchain narrative that has been brewing since the inception of scalability solutions. However, there are some risks to consider. Although low fees generally don't lead to a drop in Ethereum's price, Ryan Lee points at the potential risks of decreasing ETH capitalization. The community will be looking to see how the Ethereum Foundation and its developers address these challenges. We will see what actions the Ethereum Foundation, with its talented developers, will take, he said. Don't rely solely on network demand metrics. Kabinkin from Santiment explained that Ethereum's network strain and demand offer insights into possible price changes. There is a significant relationship between network demand and gas prices in the cryptocurrency world, especially for Ethereum and its related altcoins. A drop in demand could indicate a slowdown, possibly setting the stage for future price increases as the network adjusts and optimizes. However, it's crucial to keep a balanced perspective. The cryptocurrency market is highly volatile and affected by many factors beyond network activity. According to Kabinkin, regulatory updates, economic conditions, and new technologies also significantly influence the market. He also noted that while less strain on the Ethereum network might allow for growth, it doesn't necessarily predict a major upturn. Market expectations, as seen with events like the Ethereum merge and ETF approvals, can cause early price rises that may not last. For those tracking Ethereum and its altcoins, it's important to consider broader market trends, sentiment analysis, and technological progress. These factors offer a more complete view of potential price changes than simply looking at network demand alone. Attracting DeFi and NFT projects to Ethereum. Gabriela Cuz noted that lower fees on Ethereum could boost the use and development of the blockchain. These reduced costs make transactions much more affordable, which is excellent news for both everyday users and developers working on Ethereum-based projects. Patrick Gruen added, cheaper block space could enable previously unviable ideas to bloom involving high volumes of transactions, such as a fully on-chain version of Minecraft, OP Craft, where every river, blade of grass, and a patch of snow sitting atop the mountain ranges exists on-chain, and every single action in the world happens as an Ethereum transaction. These lower transaction costs are also drawing decentralized finance DeFi projects and non-fungible tokens NFTs to Ethereum, enhancing its competitiveness against other blockchains. Cuz further mentioned that these lower fees could help expand the Ethereum-based DeFi and NFT sectors, attracting more developers to the platform. Vijay Marolia told Cryptonews, because of the genius of blockchain technology and the cost-effectiveness of smart contracts, I see the adoption of all things DeFi increasing over the long term. Peter Eberl pointed out that lower fees encourage larger investors to experiment with DeFi on a smaller scale initially. Similarly, Ryan Lee from BitGet Research discussed the potential for innovation within Ethereum, saying, the stage of qualitative growth is characterized by the emergence of innovations. We can expect new functionalities that will push the DeFi and NFT sectors forward, especially in a situation of intensified competition between blockchains for users. Stepan Nilov added that cheaper transactions especially benefit DeFi, even beyond Ethereum's primary layer 1 blockchain, making DeFi particularly promising on layer 2 blockchains where costs are typically lower. This setup allows for more advanced on-chain activities such as Web3 gaming, social fi, and DeFi to flourish, making NFTs more attractive. Stepan Nilov explained that NFTs are somewhat complex because their main appeal lies in their cultural significance and the chance for airdrops. He mentioned when you're paying thousands of dollars for an NFT, the transaction fees don't matter as much. However, for traders who engage less in casual trading and more in seeking airdrop opportunities, gas fees still play a crucial role. Lower gas fees can reduce the costs associated with creating, buying, and selling NFTs, making them more appealing as an investment. Stan Palman said, lower fees also reduce the cost of minting, buying, and selling NFTs, which make them a more attractive asset proposition. This reduction in costs could lead to increased investments in NFTs, potentially driving up their value. Vijay Marolia also noted the impact of the current real estate market crisis, suggesting that NFTs are fantastic for real estate despite NFTs' mixed reputations. Marolia pointed out that ultimately money talks more powerfully than opinions. Impact on on-chain positions. Lower gas fees create significant opportunities for Ethereum users to manage their on-chain activities more effectively. Edward Wilson explained how these activities include yield farming, lending, borrowing, managing portfolios, and more. He highlighted the importance of timing, stating, doing this when gas fees are high will impact the expected return on investment ROI. He emphasized the importance of staying informed about market conditions to make the most of these opportunities. Stan Palman added that reduced gas fees on Ethereum's mainnet make decentralized finance DeFi transactions like lending, yield farming, and swapping not only cheaper but also more accessible. He noted, this will not only increase activity but also improve the liquidity and efficiency of the network. These changes help users engage more with the blockchain, potentially enhancing the overall health and functionality of the Ethereum ecosystem. Low fees aren't necessarily good news for all. While lower fees on the Ethereum network generally benefit users by making transactions easier and more affordable, experts point out there are some significant downsides, particularly for network security and miner incentives. Stan Palman highlighted, low ETH gas fees are not always great news for all involved. This sentiment was echoed by Gary Kabankin, who noted that although lower fees facilitate user adoption, they pose challenges for the network's sustainability. He explained if prolonged, the reduction in fees could potentially reduce the economic incentives for miners, which is critical for the security and robustness of the network. This is particularly relevant in the context of Ethereum's transition to proof-of-stake PoS, argued Kabankin. The dynamics of network security and miner compensation differ from those of proof-of-work PoW but are equally crucial. Patrick Grun discussed how low fees could affect validators or nodes, making them less profitable and potentially undermining the goal of decentralization. However, he also noted that gas levels are only a small part of validators' total earnings, so we shouldn't overestimate this risk. Edward Wilson added a perspective for the long term, mentioning that stakers, who typically have a vested interest in the network's health, may not see this as a major concern as their focus is more on long-term gains rather than immediate returns from gas fees. Deflationary mechanism and consolidating power. Stepan Nilov from Blocks Bridge pointed out a significant downside to lower Ethereum fees. They negatively impact Ethereum's deflationary mechanism. With fees decreasing, the daily amount of ETH being burned has also dropped, reaching its lowest point since the 2021 London hard fork, with just 348 ETH burned on May 19. With less ETH burn, the Ethereum supply has turned inflationary, which, in theory, could affect the price, Nilov explained. Gary Kabankin raised another concern regarding the dominance of larger entities in block space due to lower costs. He stated, this centralization could lead to vulnerabilities, including potential manipulation of transaction order or even censorship of transactions. This situation could centralize what is intended to be a decentralized ecosystem, potentially giving more power to wealthier players. Stan Palman noted a trade-off with low fees leading to increased network congestion, which could reduce transaction efficiency and negate some Benefits of lower gas costs. Essentially, this cancels out some of the benefits of lower gas fees, Pauman remarked. He also mentioned that while lower mainnet fees are generally positive for Layer 2 solutions, they could make them less appealing, slowing their adoption and impacting Ethereum's sustainability. However, Kabankin stresses that it's important to balance the concerns with the benefits. Lower fees can drive broader adoption and more innovative uses of the Ethereum network, potentially increasing the ecosystem's overall value and utility. He said the challenge for Ethereum will be to manage these economic dynamics in a way that maintains network health and decentralization while fostering growth and innovation. Is the Ethereum network safe? Recent online discussions have raised concerns about potential security issues from lower Ethereum fees, suggesting they could lead to more spam attacks. However, Peter Eberl disagrees, stating, "I don't believe this at all." He explained that this theory assumes that people will no longer stake ETH. However, if people stop staking, the yield rises, which then attracts new people to stake. Patrick Gruen acknowledged it is potentially a risk, but he believes that even low gas fees still create a financial barrier for attackers. He mentioned that other mechanisms, like the gas limit per block and prioritized transactions, help mitigate this risk. Ryan Lee further noted that traditional market fees used by Ethereum serve as an effective means of protection against spam transactions. That said, fees should be maintained at a level sufficient to make attempts to spam the network costly. 51% attack is unlikely. While the consensus is that a 51% attack on Ethereum is highly unlikely, some experts acknowledge the potential for certain attack types. Gabriela Kuss pointed out that one major drawback of lower fees is that they could make it cheaper to conduct advertising and spam attacks. Stan Pauman explained that an increase in transactions on the mainnet combined with reduced incentives for validators might lead to vulnerabilities and potential network attacks. This situation could adversely affect both users and projects, added Patrick Gruen. Gary Kabankin goes further, stating, "Absolutely, the concern about spam attacks due to lower transaction fees on Ethereum is a valid point. Despite these risks, the probability of a 51% attack remains extremely low due to Ethereum's extensive and decentralized nature. However, the lower transaction costs might make it more economical for malicious actors to launch spam or flooding attacks. These types of attacks could clog the network, slow it down, and possibly cause a temporary increase in fees as demand for processing power spikes." From poison to sandwiches, Alex Dulub, founder of Web3 Antivirus, agreed that lowering gas fees and blockchain transactions can lead to some changes in the security landscape. While it makes transactions cheaper, it also opens the door for a higher number of specific attacks, he said. Here are some of them. Poisoning attacks. Poisoning attacks trick users by inserting a fake address that looks like one they've previously used into their transaction history. Dulub explains that scammers rely on users who do not check every character of an address. When copying addresses, most people just verify the first and last few characters, which could lead them to send assets to a scammer's account mistakenly. Even with higher transaction costs, these attacks have been problematic. One recent incident cost a victim over $4 million due to a mistakenly copied address. Lower fees could lead to an increase in such deceptive practices. These attacks have been a concern even with high gas fees. For instance, Dulub said, a recent case cost the sender over $4 million after accidentally sending tokens to the scammer's address. Lower gas fees could lead to an increase in such attacks. Scam token distribution. Scam tokens are a significant problem in the crypto space, Dulub said. Attack methods include phishing tokens. Token names contain URLs to phishing sites. Honeypot/rug pull tokens. Tokens distributed under the guise of legitimate projects. Lower gas fees lower the barrier to entry for these attacks, reducing the cost and allowing scammers to target more victims. Increased front-running. Risks. Front-running, particularly through sandwich attacks, involves attackers noticing a pending transaction in the mempool and jumping ahead by paying higher gas fees. This allows them to buy tokens before the transaction and sell them at a higher price once the user's transaction increases the market price. Dulub said a notable example is a bot known as Jared from Subway F. It executed over 238,000 attacks and took more than $6 million through front-running and sandwich attacks. This bot significantly impacted the Ethereum network by increasing average gas fees and targeting meme coin traders due to their high transaction volatility and tax mechanisms. Lower fees could heighten these risks, encouraging users to pay more to prioritize their transactions, which in turn makes such attacks more viable and damaging. Productivity at work. Alex Dulub pointed out that while the rise in certain types of cyber attacks is concerning, these are not likely to significantly compromise the overall security of the blockchain ecosystem. He emphasized the necessity of addressing these security concerns to protect users and their assets effectively. Gary Kabankin added that it's crucial to consider Ethereum's ongoing improvements and protocol upgrades, which aim to enhance network security and scalability. For example, the shift to proof-of-stake changes the dynamics of network security, focusing more on staking rather than mining, which inherently alters the potential impact and feasibility of spam attacks. Moreover, the Ethereum developers and community are highly proactive in monitoring and mitigating risks. They continually develop tools and strategies to manage and quickly respond to unusual network congestion or suspected spam activities. Kabankin concluded, while lower transaction fees might theoretically make it easier for bad actors to abuse the network, the strength of Ethereum's evolving architecture combined with the vigilance of its community acts as a powerful barrier against such risks. Follow us on Google News.